Ready to go. You guys good?
Yeah, let's do it.
All right, we're already recording. Three, two, one, blam. Hello, everybody. Welcome and thank you for being here. This is just going to be a conversation with myself and two of my friends, CJ, who's a CPA, Ryan, who's a lender, and we all specialize and have worked with short-term rentals at a very high level and with a lot of different clients. And we all kind of specialize in this specific niche of a thing. The short-term rental loophole is a really, really cool opportunity. I'll talk a little bit about it more and I'll let both the guys talk a little bit about who they are and what they do and specific to like their roles in the whole loophole, if you will. Um, we'll do some quick intros. I'll start with myself. My name is Blake Anthony Carter. I've been in the short-term rental space and helping people with the short-term rental loophole for several years. We run a business that is helps people basically do this turnkey. A lot of people say that they want the ability to take advantage of the tax benefits and not have to pay taxes and also grow their equity and create cash flow, but they don't want to deal with everything that comes along with knowing how to find the right property and underwrite it and set it up and do the right design and then on to like managing it and all the things. We'll talk a little bit about management and like what all that entails. And we basically teach people how to do this. We've done it for hundreds of clients. And yeah, that's what we're here for. So that's who I am, Blake, Austin, Texas, STR Loophole expert. CJ, I'll go to you next.
Yeah, I'm CJ Tarantino. I'm a CPA and I specialize in real estate tax strategy. And I work with a lot of high income earners, doctors, dentists, business owners that are really good at what they do, but they're writing big checks to the IRS and they're always looking to explore options to mitigate their tax liability. So this has become a really good strategy for that specific use case. And I'm here to help guide you through the tax standpoint and making sure that you do this the right way.
Awesome. Ryan?
My name is Ryan Jones. I'm with the life changing team at Cross Country Mortgage. We specialize in all types of investor type of loans, whether it's DSCR, conventional. We help a lot of short term rental investors looking to get financing for their projects. And I'm also an STR investor too and Superhost. So, kind of come from both worlds, not just a lender, also an investor, and kind of know how it all works. So I appreciate your time.
Yep. I love it. I wanted to get all of us together on this call because like I said, I kind of handhold these high income earners that want to take advantage of this strategy through the whole ordeal. CJ is the expert and our go-to in regards to actually doing the things to get your tax benefit, and he's the expert in like how to do it, how to structure it properly, all that. He's your go-to. And then Ryan is who we use to actually finance and fund these properties because it's not like you don't have to go and spend, actually $500,000 to go buy a $500,000 house. There are options. And Ryan will talk about like what the lending options look like and all that. But ultimately, the short-term rental loophole is a massive tax play that not enough people know about, and not enough people are taking advantage of. It's there. It's a huge opportunity. We have clients that are effectively they're able to go buy these properties instead of paying the IRS. They can kind of rather than paying this fat chunk to the IRS, hey, buy one or two properties and you can eradicate a large portion, if not all of your tax bill potentially. And at the same time, you're growing your wealth and you're creating additional cash flow, right? A lot of what we do is helping folks to make sure they structure the deals appropriately and they're finding the right deals that will do well for them. And then you get your tax benefit. And look, I mean, some people come to us and say that I don't care if it cash flows. I just want my tax benefit. We've had people write off 100, 200, $300,000 off their tax bill just from this strategy. The STR loophole stands for short-term rental loophole. It's called the loophole, but it's in the tax code basically. You buy a short-term rental, and short-term rentals are basically effectively the only asset that allow non-real estate professionals to take advantage of what's called 100% bonus depreciation. And what we're seeing right now with the big beautiful bill coming back and allowing 100%, or the big beautiful bill coming in and allow 100% bonus to come back, is we're seeing, typically somewhere in the range of 20 to maybe up to 40% of a home's purchase price can actually be used as a write-off, right? Like it totally depends. CJ, I'll let you talk a little bit more about that. It depends on like the property versus structure value as to like how much write-off that you can get. But it's a strategy of like, hey, I'm paying too much in taxes. Let's not give that money to the IRS. Let's give that money to yourself. Let's reinvest it. Let's create generational wealth and cash flow and all the beautiful things that we love to talk about. And there's some really cool strategies all around it. And really what you do with the short-term rental loophole is you find a property, you buy it, you run it as a short-term rental, meaning like an Airbnb. It has to be rented out an average of less than 7 days. You are going to do what's called a cost segregation on it. And then you're going to be able to take advantage of the 100% bonus depreciation, which is this massive tax benefit that we're all talking about. So that's kind of a quick overview. CJ, I'd love for you to kind of go into more specifically around like what this looks like from a tax basis, what's required, and then Ryan, I'll have you kind of talk about how people can fund these properties.
Yeah, awesome. Let's dive into it. And really passionate about this topic because I've seen what it's done for my clients and the results they've gotten. And Blake, really good breakdown of the strategy. So I'll talk from a tax perspective on how to do this correctly. And so you touched on something really important, right? Why are short-term rentals different than like other avenues of real estate? If you go down the rabbit hole of how do I experience tax benefits within real estate, you'll start to run into like real estate professional status and some limitations there if you can't spend your full time within real estate. So the short-term rental loophole has become a really good approach to achieving the same result. And that result being using real estate losses that are created from bonus depreciation, cost segregation, being able to use that actually against your W-2 or business income. So that's the result that we're looking to create with this strategy. The key component with this is that your property needs to be rented 7 days or less on average. And what that does is it allows the IRS to look at your property as not as rental real estate technically, but more of an active business. So you're opening the door for that approach, and you're not subject to those real estate professional rules, the passive limitations. Now there is a participation requirement that you need to have within this property to achieve this result. So there are the material participation rules. I won't bore you with the list of what all of those are. Most commonly, people will meet this with spending 100 hours and more than anyone else involved. So you definitely don't want to overlook that second part more than anyone else. So you'll need to keep track of your hours as well as anyone else involved. So handyman, cleaners, those types of things. And it's definitely it's critical to the strategy to be on top of documenting your hours. In the case if you were ever audited and challenged on it, that's going to be your documentation, and it takes away from an audit being a scary thing to, hey, here's why I took this position, totally within my right to do so, and I did this legitimate. And so you want to do that proactively, right? You want to do this as you're working on it, come up with a system. It could be as simple as an Excel or a Google sheet, just day, hours done, what description of the work done. And it's not something that you want to do just at tax time. I'm going to kind of throw this together. That's where you're going to run into potential scrutiny with just kind of throwing this together. I stress this a lot because these are big benefits and results you're creating on your tax return. So you just want to make sure that this is buttoned up and documented correctly. Um, so that's a big piece of it. And then I know, Blake, you touched on the cost segregation study, which I'll break that down kind of quickly without getting too much in the weeds. But what that does is, so first you've bought a property, you're renting it out on VRBO or Airbnb, and now you're running as a short-term rental. The next piece now is, how do I create this depreciation effect? How do I get bonus depreciation, which just really means how do I write off depreciation in 1 year as opposed to waiting over a period of time. For short-term rentals, it's 39 years if you don't do a cost seg that you're going to recover that depreciation benefit. So you work with a cost segregation firm. If you were to work with us, we have a number of people that we work with that are really good at this. And what they do is they look at your property, they assess what's structural, what's land, what's can be broken out as land improvements, personal property. And why that is relevant is that those reclassifications are eligible for bonus depreciation, meaning they can be written off in 1 year as opposed to waiting that 39 years. Blake, yeah, touched on it. Very commonly, we see 20 to 30%. Every property is a little bit different. You also want to be mindful of in different markets, land values can be a little bit higher than not. So just want to factor that in. And land can't be depreciated, so that's why that's relevant. It may decrease the depreciation benefit. But yeah, you're going to get that cost segregation study done. You're going to have your hours. That's what opens the door to being able to actually take that depreciation benefit against your W-2 or business income. And then I just wanted to touch on, what are some common mistakes that we see with the strategy I think would be helpful. Just some practical examples. Like I had mentioned with the participation, you really just want to be mindful who else is involved, particularly in that year when you're doing the cost segregation study. Very critical that you track that very closely. Also, a lot of people are looking at their tax situation towards the end of the year, and they're looking at, hey, how do I reduce my tax bill? And if you're doing that later in the year, you just want to be mindful of timing, right? In order for you to do this in a given year, it has to be ready to go, place in service. You're going to want a couple stays at your property before the end of the year to really substantiate this. And so just want to be mindful of that. Like I had mentioned, you're going to want to get the cost segregation study. That's a critical piece of it. And then really just where we see people kind of run into some issues that you think like, hey, I'm just going to buy a short-term rental and now I got the tax benefit. There are these critical documentation pieces that you need to make sure you're aware of. And ideally, you want to make sure you're working with professionals that are doing this with clients, right? So lenders that are working with on this strategy with clients, professionals such as Blake and myself, and that's critical as well. And I think just to kind of come full circle, I think who this is. We've seen it be a really good fit for is that if you are earning significant W-2 income or business income and you're writing a big check every year and you've been told like, hey, there's really not much you can do, this is definitely something that you should consider and consider as a legitimate strategy to reduce your tax bill.
Love it. Thank you, brother. All right, Ryan, give us the master class on how people can finance and fund these properties and what you're seeing.
Absolutely. Yeah, thanks, Blake. So guys, we specialize in all types of lending. So obviously conventional Fannie Freddie loans are always going to be an option for high income earners, W-2 employees. It is very easy to get qualified, but the biggest product that we're seeing that most of our investors are taking advantage of is the DSCR loan. It's a debt service coverage ratio loan. And so what we do with that loan is we qualify clients based off the rental income that's projected with the property you're looking at purchasing. And as long as the rents cover the mortgage payment, you're approved for the loan. It's as easy as that. And the beautiful thing about it as well is we can qualify using an LLC. So if you have an LLC entity in place, we can close the mortgage in the LLC and we can also close and title in the LLC. And what that does is it doesn't show any type of liability on credit when you guys are going and doing purchases later on in life with purchasing, primary homes and stuff like that compared to the conventional loan. So we've seen a huge advantage with that, and also the interest rates are very competitive with that product as well. So another thing that we've done a lot of, and Blake and I have done, is hard money lending too. So we are also a hard money lender. We offer opportunities to fix and hold properties. So if you guys are looking to roll in the cost for putting the property together to where you need it to perform the best. That's
Yeah,
something that we've
can you
done
actually
as
talk a
well.
little bit more and explain hard money versus like a DSCR versus a conventional loan?
Correct. Yeah. So conventional and DSCR loans are obviously going to be more permanent type of loans, typically 30-year fixed loans. We can do shorter terms for those types of loan products, but doesn't allow you to build in rehab costs. And so a lot of these projects that Blake's doing right now is they're stabilizing these properties to be top performing properties in order to obviously get the most income out of them. So, adding pools to the properties, um, you know, updating the kitchen and making sure all the bathrooms are up to par in order to get the most out of your Airbnb listing. Those are things that we can do with a hard money loan. We can actually help you purchase a property that may be a little distressed or outdated, but it'll also allow you to roll in the rehab costs in order to upgrade the property to where you need it to be. And then from there, once stabilized, then we put it into a permanent loan for you, whether that's a conventional or DSCR or any other type of non-QM loan that we may want to qualify you for. So
I love it. Can you also talk a little bit just briefly on what a DSCR is? Because I know a lot of our folks are
yeah,
obviously those two.
yes. So DSCR is a debt service coverage ratio loan. So what we want to see, like I said before, is we want to make sure the property's income covers the loan or the total pity payment. So principal, interest, taxes, insurance. That's the total payment you're going to be paying every month on this loan. And so the DSCR loan will qualify off of the Airbnb projected income for that property, and we can use that. So, like I said before, as long as the rents cover the mortgage payment, you can qualify. Um, and these loans, they only require a minimum of 20% down. So instead of, like Blake said earlier, purchasing a house for 500,000, we could purchase a house for 500,000 with 20% down only. And that's another thing that, when it comes from a tax standpoint, you guys talk about the loophole that, a lot of loans that you take obviously is tax deductible as well. All the interest you're paying on it, all the closing costs, those are tax deductions that you can take for that year when you purchase the house. So,
Yeah.
lots of good stuff out there.
One other thing too, not to keep probing you, but is the second home loan.
Second home
Seen
loan.
a few
Correct.
people be able to do those and be able to put less down.
Correct. Yeah, a lot of people are purchasing vacation homes, and typically with those types of loans on a conventional basis, it only requires 10% down. Now you can only do it one time, but it will allow you to purchase a vacation home that you won't be occupying, obviously, but using it for vacation purposes. So
Love it. Love it. Thank you, brother.
absolutely.
So what I want to do now is I have some kind of cool examples. I'm going to share my screen and show some actual deals that our clients have done, so that folks can see what the actual numbers, not just on the cash flow and all the fun stuff, but on the tax benefit as well. So let me share my screen. There we go. Y'all can see my screen.
Yep, looks good.
Yes. All right. Beautiful. So these are just some photos of some projects we've done. Uh, Short-term rentals are really cool in that you can have a lot of fun with the design. They don't have to be as crazy as a lot of these, but these are really good at getting people's attention. So I put them on here. We've done properties at every level from, this is a $2 million deal that they cash flow $10,000 plus a month on. Something like this is actually a much smaller property. This was like a $400,000 purchase price. And, you can do all kinds of different ranges depending on what your goals are and what you need. I have this like sample STR loophole in action graphic that I did not use AI wink wink to make. So we have Gary the Gastro. I show this to folks a lot, but he has a 400K salary as a gastroenterologist. He buys a $500,000 short-term rental with 20% down, closing costs, and like renovation, design, all that. He's spending $155,000 out of his pocket. That property is creating $85,000 in revenue. after expenses and mortgage, he's cash flowing around $20,000 a year, and that's a net cash flow additional to his pocket. He's able to generate $100,000 paper loss, and based on his tax bracket, that is a $35,000 direct tax savings. I'm not the tax guy. CJ can talk in much better detail about all this than I can, but this is just a very good example of one property that this actually isn't even like an actual property, but it's really just a good example. So you're creating long-term cash flow, long-term equity growth, and the tax benefit. You get access to really quality real estate as well. We went over all this. So these are some actual case studies. And I kind of wanted to give different examples. This is a full rehab. This is like a luxury, all in crazy deal, like really fun one. And this is a property that was already operating as a short-term rental that we went in and improved. And I'll kind of go over the numbers on these. So this is what's called a BRRRR in the real estate world. If you're not familiar, that stands for buy, renovate, rent, refinance, and then repeat. And they created it as a luxury, wonderful short-term rental. They bought it for $450,000 on hard money, and they did some amazing stuff. You can see like the interior design was just done at a super high level. They added the pool, outdoor movie screen. They did a sauna. This house itself was like a 5-bedroom house in a suburb just outside of Austin, and it is performing very, very well. They're grossing around $150,000. And we're actually now managing the property for them. They had to do a partial service management at first, but now they're on into full service, and they're cash flowing around $3,100 a month in net cash flow. And their direct tax savings, not like write off, their direct tax savings on this property was $77,000 off of their tax bill. So really, really, really cool deal. So they're generating a lot of cash flow. They have immediate equity, and they have tax savings. This is a really, really fun case study that I love to show. They purchased this property with only 10% down on really cool terms. This is actually on seller finance. This property is generating over $300,000 a year in revenue. Nutty, nutty, nutty stuff. They are net cash flowing over $10,000 a month. So not only did they get $205,000 of direct tax benefit, again, that is not a write-off, that is direct tax benefit. But they're also generating over $100,000 a year in additional cash flow, and again, long-term equity appreciation. This is an example of a short-term rental that our clients purchased that was already operating. One of the cool opportunities to be able to go and buy these short-term rentals that are already in operation and improve them so that you can, make some money at the beginning. And then after a couple months of acquisition, you get your plan together, get your permits together, whatever, and do some really, really cool improvements. On this one, they purchased the property for $425,000 between the renovation and design updates. And by the way, not every property has to be renovated, but these are just some ones that did. Between renovation and design, they spent another $65,000. They were able to increase the property value to $540,000. So that's about a $50,000 increase in net worth just immediately off the bat. And they increased the revenue. The property was previously generating only $32,000 a month. Or, I'm sorry, $32,000 a year. To now it's generating $87,000 a year, and they're net cash flowing $1,200 a month from this purchase. They got a direct tax savings of $45,000, which is awesome, right? So they're creating wealth, they're creating cash flow, and they're getting amazing tax benefits. So these are some like straightforward examples, real life examples of our clients that have had awesome success doing this strategy. I'm stopping to share my screen. Go ahead. Did you have something, CJ?
Yeah, I just wanted to make one point because I think you were showing there, right, is their actual tax savings
Yes.
in dollars, right? Because we get a lot of questions around confusion around that, right? Is
Yes.
what's the tax deduction versus tax savings, right? So the tax
Yes.
deduction is the result of like the cost segregation and the bonus depreciation, right? So call it $100,000 tax deduction. You then the simple way to look at this would be what's your effective tax rate? So let's assume you're in the highest tax bracket and 37%. 37,000 would be your dollar tax saving. What did you actually save in dollars? So just want to make
Exactly.
that clarification because we get that question a lot.
Exactly. So
Yeah.
$100,000 write-off would equal a $37,000 direct tax benefit. Boom.
Yep. Yep.
I love it. So yeah, I that's really what I wanted to show. This is the kind of high level overview of what this is. If you guys really wanted to go into more nitty gritty about your specific situation, reach out to one of us. CJ, if you can start, please tell people where they can find you.
Yeah, so you can find me by first you can go to our website tarantino-cpa.com. We have a short form to fill out there, and then you can book a call with us. We do a free discovery call just to really assess your situation, talk through it, see if it's a good fit before you move forward or anything like that. Then we can put like a link here as well to make that a little bit more direct if possible. But that's the best way to reach out to us, let's get a call scheduled and talk through your situation a little bit more.
Awesome. Very cool. Ryan,
Yes, sir. Sorry, having some technical difficulties. Yeah, you guys, you could reach me anytime. My name's Ryan Jones. I'm the owner of Life Changing Lending, and we're also associated with Cross Country Mortgage. You can reach me anytime, 512-537-7109 or ryan.jones@ccm.com. Appreciate the
love it.
opportunity, Blake.
Of course. My name is Blake Anthony Carter. My company is Cribs Consulting. Our website is cribsconsulting.com. You can also find me online on any of the social media, Blake Anthony Carter, and reach out to me there. Otherwise, if you go to our website, you can schedule a discovery call as well. So, yeah, thank you guys, gents, for being here. Really appreciate it. It's going to help a lot of people. And yeah, thank you guys for being here. We'll talk more soon.
Thank you. Appreciate you guys very much.